7 reasons investigating market trends leads to wealth. 1. The early mover advantage. Trend analysis empowers you to identify and act on opportunities before they peak. By studying market data, you can spot a nascent trend while prices are still attractive, positioning yourself for substantial gains as the trend matures and the majority of investors begin to pile in. For instance, in 2025, AI-focused investments beat traditional benchmarks by as much as 20%, rewarding those who recognize the trend early. 2. Riding a powerful tailwind. Investing in a well-established trend is like sailing with the wind at your back. When you align your portfolio with a long-term market shift, the momentum of the trend itself helps carry your investments toward growth. A clear example is the sustained growth of e-commerce, which is expanding at over 7% annually, far outpacing traditional retail. This creates a persistent tailwind for companies in that sector. 3. Objective, data-driven decisions. One of the biggest enemies of successful investing is emotion. Trend analysis provides a framework for making objective decisions based on historical data and price movements rather than on hunches or tips. This systematic approach helps reduce impulsive actions driven by fear or greed, leading to more consistent and disciplined investing. 4. Uncovering inefficient markets. While traditional stock markets are highly efficient, many emerging trends take root in less charted territories. By investigating these areas, you can find inefficient markets where information is not yet priced in, offering a significant arbitrage opportunity. A prime example is the African digital infrastructure boom, where markets like mobile money are exploding, with transactions hitting $700 billion in 2023, but are often overlooked by mainstream investors. 5. Disciplined risk management. Understanding market direction is crucial for protecting your capital. Trend analysis allows you to set logical stop-loss orders, for example, just below a key support level in an uptrend, thereby defining your risk before you enter a trade. By adhering to the principle that the trend is your friend, you're trading with the market's momentum, which statistically increases your probability of success. 6. Cutting through market noise. Financial markets are filled with short-term volatility and noise that can distract and confuse investors. Megatrend investing helps you cut through this noise by focusing on the long-term direction of a business or sector. Instead of worrying about daily price ticks, you act as a partner in a business that is benefiting from a powerful, multi-year shift. This has led to the evolution from a simple buy-and-hold strategy to a more dynamic buy-and-watch approach in today's fast-paced world. 7. Aligning with generational shifts. The biggest wealth-building opportunities often lie in the massive, unstoppable forces reshaping our world, such as technological disruption, demographic changes, and the push for sustainability. By investigating these trends, you're not just picking stocks. You're positioning yourself to benefit from fundamental changes in how our economy works. This resonates strongly with a new generation of investors, with 40% of millennials and Gen Z already using thematic investments. How to start investigating market trends today. Ready to put this into practice? Here is a simple, step-by-step guide to begin your own trend analysis. Step 1. Collect data. Start by gathering historical data for the market or asset you're interested in. For stocks, this could be daily closing prices for the past year. Many financial websites and trading platforms provide this data for free. Step 2. Plot the data on a chart. Visualizing the data is crucial for spotting patterns. Plot the prices on a line chart, bar chart, or candlestick chart. This will give you an immediate visual sense of whether the market is moving up, down, or sideways. Step 3. Identify the trend. Look at the series of peaks and troughs in the price. Uptrend, higher highs and higher lows. Downtrend, lower highs and lower lows. Sideways trend. Price is moving within a relatively stable range. Step 4. Draw trend lines. Use your charting tools to draw lines that connect the series of higher lows in an uptrend or lower highs in a downtrend. This helps to visually confirm the trend's direction and slope. Step 5. Apply a moving average for confirmation. Moving averages smooth out price data to make the trend clearer. A common strategy is to plot a 50-day and a 200-day moving average. A buy signal can occur when the shorter-term average 50-day crosses above the longer-term average 100-day, a pattern known as a golden cross. Conversely, a sell signal may occur when the 50-day crosses below the 200-day, a death cross. Step 6. Use other indicators to gauge strength. Confirm the trend strength with other tools. Volume. Check if trading volume is higher on up days, which confirms the trend. Tools like on balance volume (OBV) can help. Relative Strength Index (RSI). This momentum oscillator measures whether a stock is overbought, typically above 70, or oversold, typically below 30. In a strong uptrend, the RSI will often stay between 40 and 80, pulling back to 40 to 50 before rising again. By following these steps, you move from being a passive observer to an active, informed investor who is better equipped to spot opportunities and manage risk.